How does risk parity change commodity investment allocation? Imagine a way of investing where each part of your portfolio shares the risk equally, rather than just the money you put in. That's what risk parity aims to do. It shifts how we think about investing in commodities. Instead of assigning a fixed percentage of your total investment to commodities, it looks at how much risk each asset contributes to the overall portfolio. Commodities tend to have higher price swings compared to stocks or bonds. Because of this, traditional portfolios often keep a small amount of money in commodities, just enough to get some diversification. But risk parity changes that by focusing on risk, not just the dollar amount. It reduces the amount of capital allocated to commodities so that their risk contribution matches that of other assets like stocks and bonds. This approach means commodities might get a smaller slice of the total investment pie, but they still play an important role. They help balance the portfolio because their prices often move differently than stocks or bonds. For example, commodities like oil or metals may rise when inflation is high or during economic growth, providing a hedge. In a risk parity setup, because commodities are more volatile, they usually get less capital compared to less volatile assets. But their risk contribution is kept in check so they still help diversify. Sometimes, investors use leverage on bonds or stocks, which are less volatile, to make the risk contributions more equal. The beauty of risk parity is that it adapts over time. If the volatility of commodities or other assets changes, the allocation adjusts automatically. This keeps the risk balanced across the portfolio. For commodity investors, this means looking beyond just how much money they invest. Instead, they focus on how much risk each asset adds to the whole portfolio. By doing this, risk parity can help create a more stable investment mix. It reduces the chance of overexposure to any one risky asset, like commodities with their wild price swings. It also helps improve risk-adjusted returns, meaning you get better performance for the amount of risk you take. So, in simple terms, risk parity changes commodity investment allocation by making sure commodities contribute equally to the overall risk, not just the capital invested. This often results in less money allocated to commodities than traditional methods, but it keeps commodities vital for diversification and inflation protection. It's a smarter way to balance risk and keep your portfolio steady over time.